Welcome to the chase. You know, we're all running this race. We're all trying to claim victory in it. In my job, I get to sit down with wealthy people all week long. I hear about their wins, I hear about their losses, and quite frankly, like a bartender, I hear about their heartache. And I don't want you to run that type of race, or at least I want you to succeed at the race that you're running. And I want you to succeed at something that matters. Think about it like this. All the while you're chasing after something that's good, God's chasing you with something great.
Well, hi, I'm Chris McAlpin, your host for The Chase, the podcast where we talk about faith, we talk about hope, we talk about love, but we do it and we talk about money. We look at the financial world, we look at the markets, we look at the economy through a biblical lens. Because, you know, this is a topic, all of these topics are some that cause a lot of anxiety in us. And even as the month of January has kicked off with the market volatility and the worries of inflation and the worries of interest rates, I feel that angst and so many of the conversations that I'm having with people. And so today we want to look at what our outlook is for the year 2022. You know, somebody looked at, they said it's like we're doing a do-over the year 20. It's like the sequel of the movie 2020. Goodness gracious, I hope not, because 2020 was enough fun. I don't want to do that one again. But as we look at the year, we look at the economy, we look at the markets, got to remember a couple of things. You know, we don't have a crystal ball. We don't know what's going to happen. That's the Almighty's territory. We got to trust Him for that. And so how do we look at a year where our resources and opportunities are going to come from, and yet there's a lot of unknowns in that? There's a couple of things I want you to keep in mind as we go through this conversation today, that your plans are areas, those are areas of an emphasis that you can control, or at least you can shape and you can be a part of. How are you financial planning? Are you reaching your goals? Are you taking steps to get there? And are you controlling the things you can control? You know, and not worrying about the things that you can't. That's easier said than done. And so education helps in that. And today we're going to talk with my good friend, Clint Sorenson, Sound Financial's lead investment strategist and the owner and founder of Wealth Shield, which is a CIO firm for a lot of firms across the country. So he's in these types of conversations all the time. He's a good friend of ours, a trusted colleague. And without further ado, my good friend, Clint, how are you, my man?
Doing great, Chris. Thanks for having me.
Yeah. I always try to come up with a cool introduction for you.
It gets better every time, which I like.
It does get better every time. It gets more intriguing every single time. So tell me a cool topic that you're studying these days, because you always are. I think last time we talked about Marcus Aurelius. And
that was what I was reading. Yeah, now I'm reading Map of Consciousness by David Hawkins, and I just finished up probably my favorite read in the last couple of years, which was Ray Dalio's recent book, which I don't have it in here, so I don't know what the title of it is, but it was fantastic. It's a glimpse on the rise and fall of empires over the last 500 years, and it was a history book done for a guy like me who wants to see it through the lens of financial markets, and it was absolutely fantastic. So those are my two reads. One I'm finishing up now. The other one I finished up a couple weeks ago. Also read Trend Following Mindset by Tom Basso recently. Highly recommended. It was a bunch of interviews with Tom Basso and Michael Covell, who has the Trend Following podcast. And Tom Basso, just a great trend follower. He started TrendStat, uberly successful. But I think back in the day, Chris, and I think you could probably share this sentiment. When you're looking for and you're reading stuff to try to learn about an investment topic like trend following, I was always looking for a system. Just tell me how to buy and sell these things and how much to risk, right? Give me the system. I don't need to know all the other stuff. As I get older, approaching 40 this year, right? As I get older, what I've realized is the most important things, the gifts that were given in these books, was the mindset and the mentality and the behavioral aspects of trading that have, I would say, changed me permanently in the way I view the world. It's kind of like when we talk about decentralization. I can't unsee it. I can't undo the benefits of having the right mindset for investing. And that book was phenomenal for that. So highly recommend that. It's, again, series of interviews with Tom Bass, a great trend follower. So that's what I've been gobbling up recently, and keep rolling. I've got the books of Enoch next, Chris. So that would be.
Oh, you're going through the Apocrypha. Okay.
Well, no, I'm not. I just watched a documentary the other day on the Dead Sea Scrolls, and it intrigued me to read it, specifically just the books of Enoch.
Just that one? Okay.
Yeah, there's three. There's three. So no, I'm not going down that rabbit hole.
I love to read the Bible, but I extra biblical texts are not
not my favorite stuff. But something intrigued me mainly about just kind of where that discovered it was like almost in perfect condition, right? And then I wanted to dig into the other one. So I read all kinds of stuff, man. So that'll show you where my mind is. It's all over the place.
In the book, the Dead Sea Scrolls are a fascinating story because of how it solidifies the authenticity of the Old Testament. It solidifies the prophecies from the Old Testament to the New Testament, most specifically about Jesus being the Christ, the Messiah. And it solidifies so much of the debate surrounding the Bible. Now, of course, it's attacked, and I love that debate and I love that conversation. But it elevates the Bible as supporting what it claims to be, which is God's word. It elevates it to a stratosphere that no other book comes close in the history of mankind. Period. And the Dead Sea Scrolls were a key archaeological component of that.
Yeah, and just fascinating how they were discovered too. Some shepherds around throwing, kids throwing rocks.
Kids throwing rocks, yeah.
Hear a break, go back the next day, and look at what you discover.
Right on.
Fascinating. Well, so I've never read it. I'm sure you've read the Book of Enoch, and my pastor, one of my best friends, has read it. And I just haven't read the 3 books of it. And I was like, well, I'm going to dig into that next and see what happens. So.
Well, all the archaeologists that have gone to the Middle East to disprove the Bible, about 120 years ago was a book titled Who Moved the Stone, and which was led by a journalist, archaeologist who went to the Middle East to disprove the Bible and ended up proving it and writing a book about it. But there's a verse in 1 Corinthians chapter 1, verse 27, I believe it is. But it says, God chose the foolish things of the world to shame the wise, and he chooses the weak things of the world to shame the strong. And just like a bunch of kids throwing rocks in a cave, break a jar and find one of the greatest archaeological discoveries in human history. And it's a bunch of kids throwing rocks. God chooses what humans would consider small and weak things to shame those of us who think are strong and wise. And he does it time and time and time again throughout human history. And it's even how that was discovered. That's this linchpin of historical evidence for the Bible continues to prove God's majesty over ours.
It is awesome. It is awesome.
Absolutely. I don't think everybody tuned in to listen to this conversation, but I'm having a lot of fun with this.
Yeah.
So let's pivot it to financial stuff for a minute, because you're talking about books that you're reading and a mindset on trend following. And there'll be a show where you and I just do trend following and we go geek out about that, because trend following is one of those topics. It's one of those investment topics that it's a favorite of yours and mine, because it gives us a mathematical system that removes emotion from investing, but it's not optimized to most people's behavior, which is a series of shows that you and I are about to get into in the coming weeks, where we talk about behavioral finance. But I think how people think about their money is so important. And it's why one of my themes this year is going to be coming back to planning, because are you walking through the proper steps to reach your goals? And if you are, stop looking at what society is telling you about money, because society gets it wrong most of the time. I mean, Clint, you and I are in this industry. We talk to people who are supposed to be experts on money all the time. And a lot of them, they're more emotional than their clients. And all of us as people are emotional. And so when we start thinking emotionally about our money, that's when we start losing our head. I had to take a trip yesterday, and I was listening to Morgan Housel's new book, The Psychology of Money. Because I'm listening to it, I may not get this quote exactly right. I haven't read the book yet, but it's on my shelf to read it. The and I think he quotes Napoleon as to what is a military genius. And military genius is that he said is that man who could do the average things well when everybody around him is going crazy. And I think in finances, when we have good plans, we can go back to those plans as a foundation of our decision making. We have systems to make decisions. So when the markets are selling off, like they've at least started off in January, you don't lose your head. You can go back and stick to your plan. And so with that said, Clint, I'm about to kick it over to you. We're looking at 2022. Just in general, tell me what you see for this year.
Yeah. So, you made a lot of great points about the emotion, the behavioral side. And, as you know, when we discuss markets, that is very much kept in mind, right? I talk to my daughter, she's 9, and I always tell her God's presence is in the present. And she's like, what do you mean? I'm like, well, you spend a lot of your time worried about the future. You're missing the beauty of now. You spend your time regretful or whatever about the past or preoccupied with the past, and you miss the beauty of now. And I think in investing, we get wrapped up in the same deal, right? We're about to have a conversation about what could happen in the future. And so that's the way I want to frame it. What could happen, right? What are the things that I think are a probability? But you have to remember, the best investment system is one that can react to changes and can adapt to regime shifts and whatever is thrown at you, and is robust enough and resilient enough to handle those type of changes. That's what makes a great system. And I know we'll talk about this later about the curse of relative returns, right, versus absolute returns. But I think a lot of the worry is wrapped up in the calendar year phenomenon, which makes no sense, or wrapped up in relative performance, which has most likely no applicability to that person's life. So when we talk about what's happening in markets, what's going to happen potentially, I want to make sure we frame it within that context. So to do that, I always start with our framework, Chris. I want to start with 4 things that we can observe to keep our mind focused on the present moment. Where are we today? And so when we do that, we always start with long-term valuations. So what are the long-term expectations for returns? A lot of people say value doesn't work. Look, history hasn't shown us that. History shows us that value does work. It just works over a 7 to 20 year time frame, and good luck trying to time it, right? In terms of where it falls when things actually go back to fair value. Good luck trying to time that experience.
Well, and I think it's important, Clint, in that you and I've had a lot of conversations of can we time it? Can we look at those types of valuations that give you these really plain signals over these big, broad time periods? Can we narrow them down to time? So you're not saying that off the cuff. You've researched. Can you use that big, broad signal, narrow it down in time with it? You're saying, no, you can't, can you?
Yeah, I haven't found something that does it in a robust fashion, right? I could data mine it, of course, and find out what valuation indicator timed it the best historically, but that's not going to be robust and likely won't work that well out of samples. So I haven't found something that works really well or will work based on our estimation of what works in the future, right? Which just means being robust, working over a bunch of different time periods, me being able to change it from a PE to a price to sales, or change the number in the denominator by little increments. Like if I'm using 10-year average earnings, use 9-year average earnings, or 7 or 6 or 15. When you make those changes, if it alters that test, right, then it's not robust by a magnitude. And that's what I mean by robust. I wanted to sit that and explain that. But yeah, I haven't been able to figure out a system time in it.
Take me to kindergarten and tell me, what do you mean by valuations, though?
Yeah, valuations are essentially where we take a measure of intrinsic value, fundamental real value for the broad market, right? So we want to understand what things are worth. Now, there's ways to do that, right? You can take 10 years average earnings history. That's commonly referred to as a cyclically adjusted price to earnings ratio, smooths out earnings, and then current price divided by that number. That's a very easy way to do it, and it's historically accurate. Market cap to GDP is another, right? So market should grow relative to the economy's growth. That's also called the Buffett indicator. And when you look at the Buffett indicator, you're saying market cap should track economic growth, right? There should be some sort of variable. So you look at that historically, and that works out pretty well. There's also market cap to gross value add, which is made famous by Dr. John Hussman. There's price to sales ratios. There's our favorite, which is the index level over an exponential regression. So line of best fit over time. There's a ton of things like that you can use. So when I talk about valuations, I'm talking about measuring what's the fundamental fair value of the overall market in this instance. And then where
is it worth $1? Is it worth $2? And the stock is priced at 10, or is it it's worth $2 and the stock is priced at 50 cents? It's not necessarily looking at the price of the stock; it's looking at the value of the stock, right? Yeah, and in this case, we're talking about the stock market as a whole, but using one stock as an analogy. What's it worth? Okay, so long-term valuations. That's number one.
Number one. We look at that, and that drives our long-term thinking. Our return is going to be above or below average. That's really what we're looking at. So when valuations are high, like they are today in the U.S., extremely high, we have to start looking for other opportunities. Where are areas that are priced for attractive returns, right? So you have to go internationally, et cetera. So when valuations are high, our rule of thumb is to diversify. I'm not going to get into heuristics and the problems with rules of thumb, but this is a good one to go by. When valuations are high, you diversify. When valuations are low, you load the boat, right? You're looking at opportunities, looking for fat pitch opportunities, and you're geared more to take risk. Whereas when valuations are high, you're geared more to preserve. So where we are now is we're very expensive in the U.S., the highest ever by many measures. Price for really low to negative returns if you bought and held the S&P. Right. So what that tells me is just diversify, look at other areas of opportunity. Second thing we look at, because 7 to 20 years, I'm not going to get into the behavioral problems with that. Right. It seems like at the tail end of every cycle, we hear the valuations are dead. Right. Echoes coming from every major media or financial media organization. And I think the problem with that is valuations count on mean reversion. You can't time when that mean reversion happens. So at the end of the day, trying to use it to predict and time things, you're going to have a pretty tough life. It's also very difficult behaviorally because you're contrarian for so long if you're a purely value investor. Think about Warren Buffett, how much he's trailed Berkshire's trailed the overall stock market in the past several years because he's been just stacking cash, right? Which from these valuations makes sense. So it's very difficult to do emotionally, especially due to the cocktail party phenomenon. If I'm going to the cocktail party with all my friends and family members, and they're talking about how much money they're making in, ARC Innovation Fund or, Tesla calls. And I'm saying, well, I'm pretty conservative because of valuations. That's not a fun conversation.
No, that's not. Right? That's not. So, one thing I want to add to that though, Clint, that cocktail party phenomenon, and your buddy at the golf course is always bragging about how much money he makes. The older I get, the longer I'm in this industry. And if you count internships, I've been around the industry since the mid-90s. I've just kind of decided that people don't tell the truth about money. they tend to lie. Yeah. I guess, are you saying, am I calling people liars? Yeah, I am. Yeah, I am. Because they come in. It reminded me, even listening to the psychology of money as I was driving last night, it reminded me of a college roommate I had in Mississippi when casinos first opened up. And he would go and lose a truckload of money, or all of his money. It was a truckload when it's all of your money. But then he'd try to convince us that it was a fun, good time, and he was getting free food and free booze, and that it was good, and we should go with him. And we're like, dude, why don't you give us your money? We'll buy you a bottle of Old Crow. You get about the same thing, okay? I mean, it's just like you're getting crushed here. But it never ceases to amaze me as people get older, how much they just either don't understand or they're just not telling the truth to their friends about how much money they're not making or they are making. And so
I agree.
The cocktail party phenomena, I love our listeners.
It just plays on our ego, right? At the end of the day. And again, the ego gets us away from making accurate decisions investing wise. And your buddy reminds me of a famous Ed Seykota quote. And Ed Seykota, great trend follower, brilliant. And he said something. He said, everyone gets what they want out of the market. And so he got what he wanted, right? He went, he can justify it how he wants to, but he went in there with the intention of losing. at least subconsciously, and end up losing. So, I think that's the problem with any investment discipline in isolation. A lot of people don't diversify by system. And on Twitter the other day, got into a conversation with Jerry Parker, Tom Basso, a lot of these famous trend followers, Richard Brennan. And the whole conversation, the thread is just incredible. You're talking about great trend followers, just bestowing knowledge on everyone on Twitter. Like, we live in the best time in the world to be able to be in contact with people like this and learn from them. And what they were talking about a lot was this whole mentality part of the trend following or investing in general, right? And I just thought it's just profound. You can't, you have to go in there and you have to diversify by system. And that's what our framework does. Most people overlook that. They call it diversify by model, but most people just say, I'm a diversified by stocks, right? No, or stocks and bonds, or stocks, bonds, and real estate. You have to diversify by system, by time frame. It creates a way better experience, and that's what a lot of the pieces of that thread were about. And I just found it fascinating. And so that's what we've done in the framework, right? So valuations are one discipline. It's based on a contrarian mentality: buy high or buy low, sell high, but it works over very long periods. So the next two components are what we call economic growth and policy, or growth in the Fed. Those two really matter over a 2 to 8 year period. That's your business cycle. And we have to include the Fed because at the end of the day, I try to have it on my background. It was an article, Fed hires BlackRock, boom for BlackRock's ETF business. That was literally the caption, right? So you've got to monitor the Fed because they are a dog that has caught its tail, but they don't know they've caught their tail and they keep chasing it, right? Because they are in full control of the business cycle through their policies, and they're chronically behind the curve now, right? So when you have the Fed that dictates the business cycle, they're critical to monitor, right? And all it matters is where are they tightening or easing, right? And where on that scale are they? So we measure that in respect or in concert with measuring, is growth accelerating or decelerating? So when you measure those two things, it gives us a great 2 to 8 year view on where the markets and the economy are. And I'm going to talk specifically about this component, right? So I want to give you the whole deal, but I'm going to talk specifically about this today. And then last is trend, right? So trend is your friend until it ends, right? I don't care if the market's telling you you're wrong, right? You might be early if you want to, appease the ego, but you're wrong at that moment in time. And so we always default back to, what are markets telling us? Are they strong? Are they weak? Where is the strength? Where is the weakness? And that matters over a 0 to about a 2 year period, but it really optimizes about 12 months or 1 year. So there you go. You got your diversified systems, diversified time periods. We're using value over the long term, 7 to 20 years. We're using growth and policy over the intermediate term, 2 to 8 years. Then we got trend that we're using over about a 1 year period.
And if we're being really honest, Clint, you and I kind of live in phases of wrong, don't we?
Oh yeah,
constantly.
We were talking about this on the investment committee call, right?
We were.
A good trend system. Because someone, again, this is a great context for this conversation, because someone said about a client, well, the client essentially wants all the up and none of the down. I was like, well, that's exactly most people do. So here's what you can give them. You can give them a strategy for cutting out off the left tail or the big outsized negative events, right? Or attempts to. That would be something like a trend following. And then the other side is they want all the market upside. And I'm like, well, then you got to handle some of that market downside. You can't cut off the whole left tail, because the moment I apply trend following to the stock market, it doesn't look like the stock market. It's not going to have the same type of return profile as just buying and holding stocks. And if you are beholden to that relative performance curse, right, where you're bewitched by it and that's all you're focused on, guess what happens? Right? You can't stick in the system and you abandon it. And that's where risk comes into play, which, your partner, Joel, has given me the best definition of risk ever. And I use it every day. And he said, the probability of a client not reaching their financial outcome. That is absolutely what risk is. And that increases when someone can't stick in the system. So, you got to diversify, you got to stay broad, and you got to keep the behavior in check.
And I think that's important. Of course, I love that definition. I've heard him say it for years, that we our biggest desire, our big goals, the reason that we do this show is for people to take their God-given resources and opportunities and recognize those as God-given resources and opportunities. We are incredibly wealthy in this country. And most people listening to shows like this are incredibly wealthy. When you look at the full scope of resources, opportunities, and money, okay? And yet, when we start chasing success and chasing security and chasing status and measuring it by money, we're finding our identity in money. Our failures start to crush us, and we start doing all kinds of crazy things. Some people take more risk when they start feeling crushed. Some people take less and they run away. We all find our breaking point in it. Whereas if we look at a solid plan that we're going along and reaching our goals, and we just recognize these as resources and opportunities, not where we find our identity. Find your identity in Jesus Christ. And find your identity in something that's eternal, something that's far more stable. Then we can accept failures, we can accept successes, and one doesn't crush us, and the other one doesn't make us arrogant, and we just roll with it. You mentioned Warren Buffett. His secret sauce is time. He's a brilliant investor. But I heard a quote by him, and I'm going to round the numbers, so I'm not going to get exactly right. But he said, basically, either Buffett or Charles Munger, his longtime business partner, said, we've owned about 400 stocks in our career together. 10 of them have made us rich. He just has been doing it for 60 or 70 years. If you count him since a kid, he's been doing it for like 80. It's his time and taking the risks and being systematic. And you know what? Everybody can do this. Everybody at every income level can have a systematic way of managing their money and systematic way of investing. I mean, you're talking about this stuff that's on Twitter. I think it's the best and worst of times because you got to kind of fight through the noise to find out what works.
Ton of noise.
Yeah, a lot of noise out there. So we got our 4 framework.
Yeah.
Let's go. Talk to me about 22. Let's just talk stock market, bond market. What's going to be on the news, right?
So when you look at our framework, we have high valuations for both stocks and bonds. So essentially, if you're just buying and holding those 2 asset classes, in my opinion, you're picking up nickels in front of a steamroller. Everyone says there is no alternative to stocks. That is not true. There are other alternatives. There are other opportunities. You don't just have to be in the S&P 500 or S&P 5 or the NASDAQ and the U.S. bond portfolio. There are other areas of opportunity. So everything we've done is we've taken this this framework and we've pulled down to themes that we think are very long term, where you can try to capitalize on some of the pricing differences or some of the trends that are going on. When you look at the economic growth and policy front, that's where our biggest challenge is, right? So you have high valuations, which mean you have low returns, means the market's more susceptible to shocks. And then you have the economic environment where there are a lot of potential pitfalls in 2022. Here's why. We had a great year growth-wise last year. We started a recovery coming out of COVID in late 20. So this is called late third quarter. We start moving into a recovery, which is below trend growth that's accelerating. Moving into an expansion in early 2021, kind of hit that peak expansion rate of change. So how fast we were moving. We hit that peak in second quarter. We slowed third quarter, and then we ticked up a tad bit in the fourth quarter, growth-wise, right? During that environment, the Fed remained pretty easy. But what we had was something that we haven't had since the financial crisis, and really since before that. We had in the last 40 years, really is high inflation. So all the pent-up demand, supply chain issues, plus 6.9 trillion per year in green spending, the lack of raw material goods, the lack of infrastructure spending to build up these, to build up the ability to provide supply as it relates to base metals. All of these things kind of, coagulated, to borrow a word from biology, coagulated into this huge precursor for persistently high inflation. So now you have an environment where you have growth that has slowed and will continue to slow. The Fed's now got political pressure to combat inflation to the point where I don't think they can, because this isn't wage price inflation yet. Wages only went up 4.7% year over year through December. That's yet to come. right? This is supply related inflation, supply chain first. Now you're getting raw material prices. You still have the secular tailwinds of deflation, debt, demographics, disruption, and decentralization. You have those backdrops for deflation, but now you have spending, which we're mistaking as growth, fueling the inflation. And so, yeah, inflation will moderate towards the back half of the year. It's just based on base effects, like where it was last year relative to where it's going to be this year. Pretty simple math. You can see it'll slow, but it's not going to slow from 7.2% back to 1.82%, the 10-year average. Likely it's going from like 7.2 to maybe 4.5. It could even tick up further and then come down to 5, right? We don't know. But that moderation is still higher than average inflation. It's going to put a lot of pressure on the Fed. And so the Fed has said that they're going to tighten by lifting interest rates and potentially letting bonds roll off their balance sheet through quantitative tightening. That is a major regime shift if you think about it in the context of the Fed controlling the business cycle. So the Fed and fiscal authorities, we printed 40% of all the dollars ever created in M2 in 2020, really in 2 months, right? That is profound. And now you're going to punch bowl.
Clint, stay on that point for just a minute. I want you to repeat that. We created the Fed. The U.S. Treasury in conjunction, because the Treasury has that.
Special purpose vehicle. Yes,
right.
We didn't just hire BlackRock. We probably hired some former Enron execs to figure out how to create a special purpose vehicle with the Treasury so that we could circumvent the Federal Reserve Act of 1914 and buy whatever we wanted. But that's
right. Right. That's conjecture. Yeah. That'd be a whole fun show right there, but we'll probably get banned from all the social media.
They're so easy to pick on. They're so easy to pick on, but they have the hardest job in the world.
They have a terrible job.
And they're just trying to do what they can, right? So I hate to pick on them. They're just too easy to pick on. So
they are. But 40% of all the currency that's ever been printed. Because you just went on a good long run about economics, and a lot of people can follow it, a lot of people can't. And that's okay. We all have different specialties in life, right? But I've always said this: there's every individual part of the economy makes common sense. The challenge is there's tens of thousands of moving parts, and so you got to kind of pull one out and just look at it a minute. And I think the one that you just said is really important. In the year 2020, the government printed 40%. Is that the right number of all the currency, of all the US dollars we've ever printed?
Ever created in history.
Okay. Yeah. All right. So when we have that, unless there is a giant hole, which there was a big hole that the Fed had to fill, it's still going to create some inflation.
Yeah, based on money velocity, right? And where money velocity ticked up. So the formula is M, which is money supply, times money velocity equals GDP or real GDP and interest rates. So nominal GDP and then interest rates. So what's the?
So let's put this in just layman's terms here. So we take the amount of dollars, right, sloshing around the economy.
Yep.
And it's also measuring how much is it sloshing, how much
they change around. That's right. That's velocity.
Because if we just piled it all out there and it just sat in one big pile and it didn't move, it really doesn't cause any problems. Doesn't cause any good either. Doesn't do any good for us either. It's got to move.
Got to move.
Right? And you're saying that now this money has started sloshing around.
Well, really what we had is I think the biggest change, and again, this is opinion, biggest change I think we had is we actually had helicopter money. People actually got checks in the mail. Yeah. That is the profound difference. So we had everything kind of shut down. So we have pent up demand, supply chain issues due to COVID. It was literally the perfect storm for inflation. And so you create 40% of M2 ever created in 247 years, right? You create that by digitally printing it, according to those are Powell's words on 60 Minutes. I digitally create money, right? So digitally created that.
All right. M2 is money.
Yeah. Okay. Money supply.
Not M2. Clint, you're the only guy. You're not the only guy that calls it M2. But it's called money.
Yes, money. So create all this money. All right. And it actually gets into the real economy this time because we send out a good chunk of the fiscal stimulus into people's bank accounts, right, through various projects.
Sure. And do you remember that 5 minutes that the Democrats and the Republicans got along in the spring of 20? It's because everybody got their way. All you have to do is just write a piece of paper and say, hey, here's a new way I want to put money into the economy. And everybody went, yes, okay. Pass mine and I'll pass yours. And so we gave money hand over fist.
And now we have the hangover. That was the overindulgence, money printing to rescue the economy. I get it. I'm not faulting anybody.
I'm not faulting anybody either, but you're right. Now, we got the hangover.
But now we've got everyone the hangover, and I'm not a big drinker, but I know that I've always heard hair of the dog cures the hangover. So you got a big hangover, you got a slowing economy, you got the Fed tightening into that slow economy, and now they're saying, I'm sorry, you're going to have to deal with this hangover because I'm taking the punch bowl away. Two scenarios. So now we have two scenarios. That
actually is the best way, if I remember from a long time ago, to deal with a hangover is to take the punch bowl away. So that's the dog just kind of creates it. It just keeps it running for a little bit longer. Just take the punch bowl away and let me feel bad and get it over with.
Yeah. So behind door number one, you have they take the punch bowl away to try to fight inflation. There's got to, again, remember political pressure on the Fed, right? You've got high inflation, you got big midterm elections, you've got voters who are being taxed at the pump, consumer confidence is dropping like a rock. And all of a sudden this is happening because you have higher rates of inflation. It's all you're hearing about. So you've got a market that's dependent upon Federal Reserve dollars and stimulus, right? And everyone feels good about that because we're obviously targeting the wealth. We being the Fed, and our policy is targeting the wealth of Fed, right? We boost if we put money into the economy, right? It looks like growth. People get optimistic. Their assets rise because we get asset price inflation. We haven't had to deal with raw material price inflation until recently. But you get asset price inflation, everybody feels good, and you get a positive feedback loop. Those people that feel good, they go out and spend more. Those businesses do better, it creates more investment. You can see how the cycle works, right? It's a psychological thing that does work. Fed targets that. So step one, I'm going to get rid of that, right? That's behind door number one is what the Fed is saying they're going to tighten. I think they're going to walk back their tightening path first through communication. If they don't go outright accommodative in the back half of the year, probably after we have a pretty nasty scare in the second quarter from a growth perspective, because it's just math. Year over year growth in the second quarter last year was the highest we'd seen, 16.67% nominal GDP. That is a very high number in nominal GDP. And that was because second quarter 2020 was so low. Now we're facing that as a comparable year over year as we enter second quarter. So as the more time that passes between now and second quarter, the worse it's going to get. We're getting closer and closer to that growth scare. And the Fed's still talking about hiking interest rates 4 times this year and probably letting bonds roll off of their balance sheet and starting QT at some point. So the conversations are amazingly hawkish. So I see that if we choose that door, I see what's going to happen is you're going to get a market event, most likely in response to growth, whether it's a rotation to low volatility, a lot of the high quality stuff, and then your other, your more risky cyclical stuff starts to sell off, or whether it's an outright broad market decline. I'm not convinced this is what we're seeing now, but it could turn into that. Who knows, right? But I could easily make the case, because every time the Fed is hiked into a slowdown, you have had market events, that we will have a market event, right? Now, that's a small sample size, so I'm not going to get into representativeness bias here, Chris, and talk about my sample size neglect. But at the end of the day, I think that's you've got to assume that that's a possibility or a probability. And so that's behind door number one. They tighten, it creates a market event, and then they are in a pickle. That pickle is, do I continue down the path to fight inflation, right? Which is politically feasible and going to get some pressure politically to do that. Or do I walk back my tightening, which I think they'll do through communication? If that doesn't work, go outright easy to rescue the markets. I think they have to do the latter. And if they do that, then it poses a whole new world of potential negative effects from a geopolitical standpoint, from what does that mean to the dollar, what happens in markets, right? And so that's your scenarios you're faced with. You've really got those two scenarios. And with the economy going to slow in the front half, inflation not set to moderate to the back half, you've got a timing mismatch, which puts a lot of pressure on the Fed. And so I'm going to simplify this and tell you through the business cycle what the Fed typically does And then I'll talk about where it's really a pickle, and you'll see the glimpse. So throughout history, you have 4 business cycle phases. You have recovery, which is below trend growth that's accelerating, expansion, which is above trend growth that's accelerating, slowdown, which is above trend growth that's decelerating, and then contraction, below trend growth that's decelerating. Those are your 4 business cycle environments, right? So when you think about those, where we are now is in that slowdown phase. Above trend growth for sure, right? And will be most likely above trend through the course of this year, but we are going to be slowing, and that slowdown is going to really accelerate to the downside come second quarter. So that's where we're at. In a slowdown, the Fed typically eases through communication. They start talking about how they can cut interest rates. So this is the problem with them now controlling the business cycle. They're perpetually behind the curve. And that being behind the curve, because they're controlling the business cycle, they're always a step behind. So every time since the global financial crisis, they have tightened to a lower level of Fed funds rate, a lower level of interest rates, broadly speaking, from an economy. So thinking about the treasury curve, right? And have had to change course quicker, right? So if you think about their tightening path, they're tightening to lower and lower levels. And that's problematic. I don't think they get much in the way of interest rate increases before the market really starts to call their bluff. And so I think that's the world we face right now. It's a very, very challenging environment for the Fed. I'm calling it the Fed pickle. I don't know how they handle it, right? Because they're going to tighten where they typically would have eased. Now, when you have this environment of easing and a slowdown, the only time we see that problematic is when you have high inflation. Then they're in a box. That's more of a stagflationary environment. So you have, you can't ease to try to rescue growth. So what happens if you ease? You cause more inflation.
If you cause more inflation, hair to the dog.
You cause more
back to hair to the dog.
Yeah. So then you start to possibly weaken the dollar. Then interest rates fall. Yeah, you might rescue markets, but you could potentially get more inflation. The second thing is if I try to fight inflation, I kill the economy.
You kill the economy, you kill the market. But I mean, if we go back to the 80s, last time we had really bad inflation in the economy, President Reagan and Volcker, they killed the economy. They killed the markets. We had 2 big bear markets in the first 4 years of the 80s, and President Reagan was still reelected. I mean, in a landslide. You're right, because they had the courage and leadership to do it. I don't think that we have the courage and leadership in Washington from either party to do work like that today. I'm just looking in DC today. I don't think anybody has that courage and leadership to step in there, take the shots, to say this is the best thing for us. Now, but let's take this down and let's say, all right, what we're looking at this year, what we believe we're looking at this year is, number one, the Fed can fight inflation, hit it hard, and they're probably going to crush the market if they do it, because they got to raise interest rates. They know they can kill inflation. They can do it. Or number two, they've signaled right now that they're going to raise the rates four times this year. They verbally come out and say, no, we're just going to raise them twice. The market's going to cheer. Yay, good for us. We get a little bit more of the drug, and the market's going to V up, and everybody will think all is well.
That's right. That's what you're looking at.
That's really short-termism, really short-term thinking, and looking at 2022. Now, but that's the world we live in, Clint. I mean, that's just the facts of life. All of my career, we've had conversations about Fed and interest rates and recessions and bull markets. And this is normal. I mean, this is just business as usual. It's no reason to panic, no reason to worry. I think we look at stock markets right now and it sells off 3 or 4%, and everybody goes into a panic. Like, oh my gosh, we're going to go buy the dips. Let's just jump in and buy them right now. Like, holy smokes.
Just zoom out.
I remember a day when the market could sell off 10% in a month and nobody even noticed, because they're not watching them all the time. I'm amazed by how many people watch the stock market all the time. But, I mean, it's our job. We do this.
People are off sides. There's a lot of people off sides here that have taken too much risk because of the relative performance curse, the fear of missing out. And that's what creates these air pockets to the downside when you get events. And that's why every little event, there's in system dynamics, if you think about how systems work, there's a theory that the farther something gets away from equilibrium, the more susceptible to shocks it is.
Yeah.
So we're in the U.S. stock market. If you look at the Buffett indicator, market cap to GDP, we're over 3 standard deviations. That's not 99% of observation. Market's not normal, but I'm just giving you a context. 99% of observations should sit between 3 standard deviations above and below an average, right? 99%. So all of them, mostly.
All
right?
of them, yeah.
We're over 3 standard deviations above fair value. We are extremely susceptible to shocks. And that's why I think you're seeing such volatility on the littlest things, right? And I think that's just a symptom of that overall fragility in the market. And so I think, the best way to prepare for this, Chris, we talked about this on the investment committee call. I mean, I think you guys are positioned so perfectly because why? You have an ability to adapt and react to the changing regimes and environment. You're diversified by system. You're diversified by time period. We can talk and pontificate all day about what Jerome Powell is going to do and all this stuff.
Yeah.
But at the end of the day, we have a system that we follow with discipline, and it doesn't matter what we think. And I think that's the beauty of it. If you ask me, hey, what's the best thing? I think those investors that follow a strategy with discipline and don't waver, they're going to be successful in 2022. They're going to thrive. I think the investors that are pulled at every letter in the Fed's minutes and every comment from a Fed head and every growth report or jobs report, you are going to have a miserable time because guess what?
That's a lot of miserable reading anyway.
Yeah, there's some truth. There's some sad realities there, right? When you unpack it, number one, you can't predict anything. So come to that realization as fast as humanly possible. Yeah. You can't predict. Number two, right? If you have to have a strategy and a plan, right? Because again, going back to that comment I always share with my daughter, God's presence is in the present. Control what you can control. Take one step at a time. Focus on what it's like the serenity prayer, Chris, right? You focus on what you can control, understand what you can't, and stick to your process. That unequivocally is the best investment advice anyone could have. If you do that, find a system that works, have a coach and advisor that can keep you on track to follow your system with discipline and to get you back on track when you get off, because it's going to happen, right? To have that accountability and that focus and then stick to that. That is your goal. It's about absolute compounding of your money, and it's about allowing yourself time. Right? A great systematic approach to investing gives you time to survive so you can capitalize on those opportunities when they present themselves and your system picks up on them, or avoid the major collapses because you have a system that's designed to do that. That is the goal. It's not keeping up with the S&P 500. You do not want the S&P 500 if history is any guide. You do not want that index. I know it's performed great and it's done well. Pat on your back for buying the index fund, but odds favor if you hold that through what we're facing, you're going to have a really difficult environment. So don't let FOMO push you out of your discipline. Stay focused, stay disciplined, grab a coach or an advisor to guide you through these things and to keep you accountable and have a plan.
All right, Clint. Thank you, my man. I'm going to let that be our last word because we're going to continue this series where we're going to get into FOMO and we're going to get into disciplines and we're going to get into all kinds of isms, words that we'll have to define for people before we talk about them. But it's so important on the financial, the behavioral financials, the financial behavior side of our life. But last word for today, my friend. I appreciate you joining us. I look forward to talking to you again soon. Thank you. Well, thank you for joining us today. Thank you for sticking around. I know that we got into a lot of economic minutia in that topic, but Clint is a wonderful resource, a wonderful team player of ours, and he and I can really get on a roll. When it comes to this topic, there's so many moving parts, and we feel like we can control them. And sometimes even I'm terribly guilty of that, the more education I have, I feel like I can be in control. And I can absolutely tell you, I'm not in control of the markets, the economy, which direction either one of those are going to go, and neither are you. But I mentioned this verse, and it really is significant to this conversation when we get worried about it. And I'm gonna read the entire one now, but it's from 1 Corinthians 1, verse 27 and 28. But God has chosen the foolish things of the world to shame the wise. God has chosen the weak things of the world to shame the things that which are strong, and the insignificant things of the world, the despised, God has chosen the things that are not, so that he may nullify the things that are, so that no human may boast before God. And we can look at the universe, we can look at creation, we can look at mountains, we can look at canyons. And yes, we can look at the economy, we can look at the markets and go, you know what, I'm not in charge, and neither is any other human on this earth. That things are going to happen. There's going to be rolling events of ups and downs. And it's why I always come back to a handful of things. You are blessed. You're blessed to live in an area full of wealth. You're blessed to live surrounded by resources and opportunities. You can have an excellent financial plan, but this, if you put your hope, you put your dependency, you wrap your identity up in that money, it is going to crush you, and you will never, ever, ever have enough. As I'm going through the book that I mentioned, the psychology of money, he lists out what the top baseball player makes compared to a rookie baseball player, and what a top baseball player makes compared to a rookie hedge fund manager, what a rookie hedge fund manager makes compared to the very best hedge fund managers. We're talking $300, $400, $500, $700 million a year. And we mentioned Warren Buffett, and there's been years that his net worth rises by $3 to $5 million. Well, King Solomon once wrote a book in Ecclesiastes, and his net worth is estimated to be over $2 trillion. And he said every bit of it is vanity. All of it is vanity and worthless. And the only thing that's worth anything is chasing after the things that are God, that are godly. In other words, finding your identity in Christ and finding a foundation. And then go do excellent work. I mean, go be creative, go build stuff, go look at that financial plan and set out steps to reach goals and dreams, and be charitable and give some of those resources and opportunities that God has given you. Enjoy some of those resources that God has given you, and invest some of those resources for the future, because those are things that are good and from God. Okay. But you don't find your identity there. You don't find your hope. You don't find your faith. You don't find your love in anything that comes from life. I say this all the time because I mean it. I want people to plan, take action, but don't trust that money. And I love what Clint said. God's presence is in the present. Ooh, that's an awesome verse, because that forces you to trust him for the future and realize your regrets of the past are forgiven. How awesome is that? And it so solidifies what we say a lot on The Chase, and hence even the title of it. And I'll wrap up with this. Remember, all while you're chasing something good, God is chasing you with something great. Take care. God bless.
For disclosure and citation information, please go to www.soundfsg.com/disclosures.